Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're sitting down with legendary investor George Noble. George is an industry veteran. He was an intern with the great Peter Lynch at Fidelity. He went on to run the Fidelity Overseas Fund, which at one point was the number one mutual fund in the world. I think of George as an intelligent market practitioner, as a thoughtful investor, someone who's never afraid to push back or challenge the crowd. He's known for calling out hype, for questioning big narratives, focusing on where capital could be getting misallocated. So with that in mind, you're going to find we talk about the AI trade, we talk about Bitcoin, we talk about gold, we talk about energy stocks. George's going to bring decades of investment experience to the current market environment for a fresh take on everything we're seeing and experiencing here in March of 2026. So please enjoy this interview with George Noble. All right, super excited to be catching up again here with George Noble, legendary investor. George, you and I spoke last in June of 2025 on my show, which has been too long, I would argue. But We talked a lot about your kind of formative years at Fidelity, some lessons learned. Hopefully we can tease out some more lessons learned through our conversation today. But I'm excited to sort of circle back with you, given what feels like quite a bit of dislocation in the markets here in March of 2026, just to get your sense on how to sort of separate the signal from the noise and help us make sense of things. We've obviously had a significant rotation from Q4 of last year through Q1 of this year. I don't know if you've noticed how much tech has been, devalued since the euphoric rise that we experienced. You should check out the charts, George.
You should check this out. Okay, yeah, fine, yeah.
But talk to me about that. I mean, you obviously were, I think, ahead of the curve in many ways in terms of talking about concerns about the AI euphoria. How has this played out in terms of your expectations, and how should investors be thinking about these growth areas now that they've been devalued to the point they have?
Deceivingly simple question. It's complicated.
Yeah.
It's complicated. So first thing I would say is, R is for rotation. It's not recession, maybe eventually, but not right now. R is for rotation and reflation. We all grew up at Fido, and as we learned, it's a market of stocks. I think it's far more interesting. You do a lot of great work in this area, David, is looking at the internals of the market, what's working, what's not working. So to wit, the last few years, if you bought an index fund, you had a very different outcome than if you bought Mag 7. If you bought value stocks, you had a very different outcome than Mag 7. So you try to capitalize on the dispersion. There's one famous commentary, this thing, angry money, mad money, whatever. And the tagline is, there's always a bull market somewhere, and my job is to help find and make you money. So you might say about me, well, there's always a bear market somewhere, and my job is to help find and make you money. The point is, some things are going up, some things are going down. I mentioned this the other day, I think you saw it. Since November alone, Schlumberger, which isn't exactly some unheard small cap energy name, I deliberately picked that name just off the shelf because when funds want to rotate into energy, they got to buy that name.
Yeah.
Schlumberger since November, I think on bad day, it's probably worse now. I think it's outperformed Microsoft by 120%.
It's probably true, right?
Yeah, no, but the point is, it's not like we're buying some obscure, Keller Oil and Gas. Like if you just shorted the most beloved mega cap and you just went long the Captain Obvious energy name, 120%. Now, there's nothing unique about those names. I deliberately picked them just kind of as representative sample of what's going on. David, as you well know, you could do XLE against XLK, all this other stuff, right? The point is that relative trade is indicative of what's going on beneath the surface of the markets. In other words, I think we're witnessing a regime change. This is not just, tech's now oversold in the RSI and blah, 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 and you should buy it. Energy overbought on the MACD, you should sell it. No. This is maybe perhaps the end of the beginning. Maybe the beginning of the beginning, all right? Tech outperformed the market for, you have to go look at the charts, 10 years, 12 years, 15 years, whatever it was, right? The U.S. outperformed the rest of the world, ditto. And it was justified. Relative price follows relative earnings.
Yeah.
Just give credit where it's due, okay? And as you know, Fidelity's most famous investor, Mr. Lynch, would always cite the example of, over 30 years, Coca-Cola went up 30x, but guess what? The earnings went up 30x. So it's not random. And it was always this creative tension between fundamentals and technicals. And people often say that, technical things happen for fundamental reasons. I like to turn that on its head. Fundamental things happen for technical reasons. Or put it another way, the chart's telling you what's happening.
Yeah.
And it doesn't really matter what you think or what I think. So what does Mr. Market think? So Keller, wise guy, you still got those stale tech positions on. They're not working out too good. Like, what's going on? And then what I love is Keller says, no, I'm 100% right on this, right? And the lack of, I'm teasing you, obviously, the lack of humility or self-reflection. Like, when something doesn't do what it's supposed to do, instead of just assuming it away, or as some portfolio managers are known to do, David, you really don't understand. Let me turn the chart upside down, okay? Like, you need to have some element of reflection and say, well, what's the market telling me? So I don't even remember what the question was. I think we're in, now I do. I think we're in a regime shift.
Yeah.
Taking on biblical proportions. The last shall be first, the first shall be last. In the same way you went, I started in this business in 81. You went through a 40-year cycle, cycle trend. There was no cycle. Rates down, 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 down. That dictates a certain type of regime. We're now in regime change. And so the things that are most sensitive to liquidity, like Bitcoin, we're going to have a problem. And things which are more sensitive to inflation and growth, they'll do much better. So you can express this any one of a number of ways, whether it's the U.S. underperforming the rest of the world, energy outperforming tech, emerging markets outperforming Europe. Small cap over large cap. They're all planets orbiting around the same sun.
So you hit on so many good points there, George. But what one of them is we're coming out of this period where just growth over value has been, I think, for a lot of newer investors, just assumed as a truism. That's just how the markets work. And so there's a lot of confusion now. And for I think a lot of those newer investors, they're seeing names like Palantir that had been rock star perfect charts, now not looking great, but they've already come down a ton. Right. So there's this temptation to think this is obviously just the latest pullback within this big AI dominance that's just going to return. So what would you tell to investors that have that mentality, seeing a bunch of big tech companies with a 30% Bed Bath & Beyond coupon available? Why would they not take a shot at that sort of
They're confusing price with value. It's two different things. Price, what everyone fixates on, because that's what you see on the screen. I'm not telling you anything about value. I'm just looking here. Excuse me, I don't have a cough drop because I got a sore throat. I'm just looking here. Foolish David Keller. Do you realize what a bargain Palantir is now? It's only on 76 times revenues.
Only 76, right?
If I said a PE of 76, you'd say, get out of here, or GTFO, right? 76 times revenues. This reminds me of other software stocks recently. Why we're going this for 5 minutes, we're having a good time. I don't see how we can possibly finish this in 25 minutes.
Right.
Anyway, I'm in this chat room with these guys. They're all younger than I am. I wish I was as young as they were, but whatever. So when I was young, I did stupid things like buy Japanese railway and real estate companies because the Mo was with me and whatever. So, youth is a great thing. So they're going on about their beloved software stock. I think it was ServiceNow or whatever it was. I don't even know what ServiceNow does, okay? All I know is it's like Palantir. Thing was, I'm going to make the numbers up. Let's say it was on 20 times sales and 200 times earnings. 20 and 200. So now it's on 12 times sales, 120 times earnings. And there was all resulting on, they all got recency bias. So we're looking at what their price was.
Yeah.
And I'm like, in what universe is 12 times revenues and 120 multiple? Is that like normal? It's not. Yeah. Your question about this generation of investors, they've been spoiled. Look, we're all human. We're all conditioned by most recent events, and they've all been spoiled. And it's been an environment the last few years. Let's be fair, that approach has been richly rewarded. But when the tides shift, you gotta be careful. I think that's what's happening right now. I'll give you one funny story.
Yeah.
That's Southwest Airlines. So we started our Substack a couple weeks ago, and I wanted to put some individual reports in. So I had to write up a report. You'll remember this, David. The old investment committee report, ICR from Fidelity days. So I go and I dig one up. These are like 3 or 4 page things. They weren't a big deal. You don't want a TLDR thing, but you had to show your work. It's like in high school math. It's like, okay, I know you got the answer right, Keller, but how'd you get to that number?
Prove it out.
The guy next to you. Okay, fine. Sometimes you get a good mark, even you get the wrong answer if the work was impressive. Okay. So I got to write up Southwest Airlines. I hadn't written a report in, 35 years. But my mind works in that form. So I start writing stuff down. Old Fidelity way, what's the outlook for, revenues, costs, labor costs, growth, competition, capital spending, free cash flow, depreciation. You just walk down the income statement, balance sheet, cash flow, strengths, weaknesses, threats, opportunities. Simple stuff. 4 pages. So I write up a report. And I was pretty impressed with myself. And by the way, little secret, don't tell any of you viewers. I discovered ChatGPT. So it's not AI slop. The critical thing is, this is one of my problems with AI. The critical variable is, I'm sure you use it, the way you prompt it, right? So there's like 3 or 4 questions that I want to address in that thing, which aren't found anywhere else. And the ChatGPT isn't going to think of that on its own. So I'm trying to write it like the voice of Peter Lynch. All right.
Yeah.
Well, in other words, if I'm going to walk into Peter's office with a report, what does he want? I know what he wants. Okay. So I write this report. I show it to my shadow partner, stroke friend. He's like, George, nobody writes reports like this anymore. I go, what do you mean? It's got fundamentals, it's got valuation. I got like the PE and the price to cash flow on the front. And by the way, I'm a numbers guy. I'm the son of a mathematician. I want to see the numbers first.
Yeah.
All the other narrative nonsense, they can wait, right? So I want to see, right? He goes, you got all this talk about valuation and fundamentals. You're laughing. You know what I'm talking about. Right now, everyone just does, what's the story? What's the narrative? What's the chart look like?
Yep.
So people are investing in trading sardines. Okay. I know you know this, David, but for your viewers who don't know this, I think maybe you want to tell the story. Was it the Tokyo fish market or whatever? About Okay, you want to tell a story? Or want me to tell a story?
No, do it. You're the guest, but this is an awesome story. Linda Raschke wrote an awesome book with trading sardines as the title, based on this story.
So I'm not going to get it precisely right, but you get the point. So that I got it was in the fish market in Tokyo, and there's a shipment of sardines or whatever. Okay. One guy buys like a bidding war, and the price keeps going up and up and up and up and up. And finally, the last guy who buys the sardines, he opens it up and he eats them, he tastes them, and he spits them out. And he wants to complain. He goes, "No, those sardines aren't for eating; they're for trading." Okay, so that's what's happening with a lot of this merchandise, and it's all good when you're watching to see liquidity, and it's all worked. The last 5 times you tried this trick, it worked. And then one day it doesn't work. And the question is, why? Is this just a one-off? We go back to regular scheduled programming, where a Palantir, instead of being on 76 times revenues, should be on 125 times revenues? Or is there change afoot? And I very strenuously believe in the latter rather than the former.
So we've had, and again, to your credit, I mean, George, I think you've had a healthy dose of skepticism for a lot of these areas and extreme valuations, and now it feels like we're all sort of waking up from this bad dream or good dream in some ways. Where's the rotation and where's the opportunity? You mentioned focusing on relative strength. Our mutual fund, John Roque, one of the best at focusing on the message of relative strength and relative performance. We've had other areas of the market, more cyclical sectors, energy obviously doing quite well, basic materials, industrials, aerospace, defense, but also now defensive sectors starting to improve. So if the growthiest of the growth is still not a great spot, like where do you see the best opportunities emerging going forward, and what are some of the reasons why?
Yeah, so you just touched on a lot of the sectors. Broadly speaking, you got it right.
Yep.
But it's always a little bit more complicated. So, for instance, give you an example. A lot of people want to call large cap over small cap, or they want to buy consumer staples. So, someone the other day, a smart guy I know, was pitching consumer staples to me. And I was like, okay, I get they may go up because money flow comes out of NVIDIA and Apple and goes into everything else. But so those stocks will go up not because there's anything necessarily good going on, but because their name isn't Apple or NVIDIA. So is it that the folks are running to the consumer staples or they're running away from tech? There's a big difference.
Mm.
So I asked this fellow, I said, I haven't done the work on consumer names. It was Peter Bachvar, actually. He's a pretty smart cookie.
Oh, yeah.
And he's in the weeds on some of these names, Procter and Gamble or McDonald's or whatever it was. In a couple of instances, he pointed out to me, he says, no, George, because I asked him, I said, look, are the stocks starting to act better? Number one. Number two, everyone's a momentum investor. We all know that. But number two, more importantly, are you seeing any positive earnings revisions? Is business getting any better? Because if stocks are just going up and business is not changing, then I'm not interested. He said, no. There are a few instances where for these companies have been in trouble for a few years now. They've been cutting costs, come out with new products. So I can't remember the names, but maybe it was Procter and Gamble. He's like, the thing's yielding 6% and estimates are going up. I'm like, okay, you have my attention. Reasonable. But look at small cap, and you would know this, Dave, because you do a lot of great work on ETFs and everything. The Russell is complete unobliterated, complete garbage, total garbage. The number's better than 40% of the companies lose money or some nonsense like that.
Yeah.
Now, if you said to me, well, you know what? Russell's been the big funding trade for a lot of guys. They're long Max 7, short Russell, right? So when they go to sell their Max 7, they got to buy the Russell. Okay, but let's not confuse that with fundamental investing. And then if you said to me, well, gee, I really think small caps are going to do well. And I don't know which of the ETFs it is, but there are some of it's the 600 or whatever it is. There's some of the small cap indices, which I think the companies ETFs were like, the company has to be profitable to be in the thing, and there's got to be a dividend yield or whatever. So it's not just some bullshit thing like Keller Pharmaceutical. All right. And so if you said to me, real small cap companies will do better. Oh, by the way, these small cap companies are also cheap relatively been historically to themselves. Then I'm interested. But, Adam Parker, who crunches all the numbers, pointed this out to me months ago. If you just look at small cap overall, it's not attractive. I mean, small cap growth is extremely expensive, all right? And small cap value, if you disaggregate small caps for factors, so how much of it's earnings volatility versus fundamentals, balance sheets, short interest, this, that, and everything else, and you put that through the blender on small cap, you will see that the Russell's not cheap. Small cap growth, again, is very expensive. The only part of the small cap universe which looks interesting or cheap is small cap value, but there are a lot of sketchy companies there. So to just say, the multiple on the Russell is 15 and the Mag 7 is 25 and it's at a 40% discount, and historically it's only a 20% discount, and you should buy this and sell that. That may work, but for the reasons you don't want to know. It's not the small caps going up or the Russell's going up. It may just be that the big cap merchandise is going to take a dirt nap. So when people say, well, you have to rotate out of it right now. No. The value in that trade, there's no alpha in the small cap trade. The alpha is in calling a spade, which is the large cap tech is garbage. I call nonsense. I call BS on the AI trade. So I know you know all this, but hopefully this is helpful for some of your viewers.
Yeah, for sure. And it's interesting. I mean, we're recording this, George, and getting back to the current market and leadership rotation. We're recording this as events in the Middle East are escalating rapidly. So just today, we're seeing, and so far this week, energy stocks ripping as crude oil prices rotate higher. We're seeing precious metals come down, rates spiking higher, the dollar starting to pop. And I know for many investors who maybe have not seen this particular configuration, getting very nervous very, very quickly. Do you have like a George Noble geopolitical military conflict playbook that you dig out in this event? Or are there nuances to what you're seeing and hearing now that help you understand?
I'd say a few things. I was speaking offline before we started this. Fade the hot takes. Fade the hot takes. Now everyone's a Middle East expert. How long ago? I'm old enough to remember when it was Jevons paradox in AI. And before that, it was shipping. And guys have posted like live photos from Long Beach, California, right?
Oh, yeah.
So the furus go from one thing to the next. Jay Pulaski famously said last year in a podcast I had with him, his superpower is he ignores anything Donald Trump says. And it's not a political statement. It's not whether he hates Trump or likes Trump. It's not it at all. It's just Trump is like a random number generator. He says one thing one day in the market, and he says the opposite the next day. So you go chasing after whatever the hot potato is du jour, fool's errand. So take energy right now. Okay, yeah, it's been gratifying the last few days. Energy's gone up. This is not why we made the call in December to buy energy. And I had to do one of these year ahead type things. I hate those things. But more importantly, it's like, what should people invest in now? I was like, all right, I still like gold and silver. But you got the taxi drivers in gold and silver now.
Yeah.
Plus, I don't know if it's become a Captain Obvious trade, but I was like, let's do better. So I was like, all right, rotation, love energy. As Roke had pointed out, despite crude doing nothing in the latter months of 25, energy stocks started to get a little bit of a bid. As you know, David, the commodity lives in the present, the stocks live in the future. So there's a conspiracy theory going around, I don't know if it's true or not, but imagine this. Price of oil is kept under wraps, relatively subdued for now, for geopolitical reasons and the midterms and all this stuff. Maybe once we get past the midterms, that goes away. But that's one possibility. But more importantly, if you look at energy oil consumption, we're very robust, consistently coming in above expectations. Severe constraints. I mean, Russian production is falling. Okay, maybe now with Iran. I mean, again, yes, but geopolitics. Look, I think this has the potential to be a huge positive what's happening in the Mideast. I think this is going to permanently change the face of the Mideast, and the next 50 years hopefully will look a lot better than the last 50 years. But right here, right now, everyone's all freaked out because you got the shipping guys now. They're all like with their binoculars, the Straits of Hormuz. Ooh, there's no boats. Ooh, there's a boat over there. Okay, they're doing this whole thing, right? So you run the numbers. I think I read a GavCal note this morning. The world consumes roughly 104 million barrels a day of oil. 20 million a day go through the Straits of Hormuz. 20 million a day. You could see an increase from size. Some other places will partially offset. So let's assume that you're losing 15 million a day. Okay. I think global inventories are 800 billion. So if this just goes a few weeks, it's not a big deal.
Yeah.
And so if we get a settlement 30 days from now, 60 days from now, this trade we're seeing the last couple of days all got to get undone. So as much as I like energy, I'm not sure I'd buy it here today. I mean, it's tactical and short-term, medium-term, long-term, right? I mean, Schlumberger is up 40% since we made it sounds terrible. Oh, did you buy Schlumberger? Okay, whatever. We got lucky. We called the oil service names in December. Valaris got taken out up 95%. Tidewater's up 40%. So, if Priest breaks out, well, all these things take a dirt nap temporarily, and then you were wrong. Yeah, but you got to use your common sense about it. So the real question is, what's energy going to do for the next week or two? Where's energy at the end of the year? I mean, it's hard. So it is, as someone would say, it's not prediction, it's the path. Like, how'd you get there? All right. Gold and silver, they're smashing these things down. David, gold has now crashed to levels not seen since February 20th. Bear market. It's a bear market. Let me tell you. It's crashing. Okay. So
it's a week and a half old bear market is what you're telling me.
Exactly, right? And they say, but silver. We can talk silver too if you want. So they're just resulting off of what the peak price was.
Yeah.
In At the Top of My Life and Times by George Noble, still to David Keller, all right? Otherwise, you look at this, we talked about earlier, you look at this stuff, it looks great.
Yeah.
So if it gets sold off right now, fine, I don't care. I go back to what I said a few minutes ago. I don't look at things on a daily basis. It's funny. This morning, a good friend of mine, I'm not going to mention who it is, he's on X. He's trying to pull some George Noble move, or old George Noble move. He's trying to make the call. So the market dumped yesterday morning. He goes, I'm buying this. Okay. He got really loud on X. All right. And then, by the end of the day, last night, he's, oh, look at me. Hail the chief. Right. Okay. Couldn't resist. I sent him a DM like an hour later. I said, Dave, how's you doing? Okay. Is the crap down from your entry point yesterday? I mean, it's like, come on. And this is not investing. You know it and I know it.
Yeah. Yeah. No, it's true. And there's such a temptation. And I think that's one of the rookie mistakes you see with anyone getting into this industry or getting, trying to take control of their own portfolios. You overreact to short-term data. You underappreciate the long-term story. So with that in mind, you were, again, I think pretty good. This was like back in April of 25. I saw you post on social media, your appearance on the Schwab Network talking about gold going much higher. This is when gold's like $3,200, $3,500 an ounce something. Mm-hmm. Now it's obviously higher. What and again, it's gone up despite the fact that risk assets have ripped higher and have a great trend. So but what help us not overreact to the short term and understand the long term.
Okay, so you think about the drive. Let's going back to failures. Like, what are the fundamentals?
Yeah,
underpinning. Have the fundamentals changed? You know this, David. Sometimes stock price goes up a lot. You own it, goes up a lot, but you're like, oh my God, the story just got better. Sometimes the stocks are better by at a higher price than it was at the lower price because the story got better. What you're trying to do is arbitrage difference between perception and reality. Conversely, just because the stock's down doesn't mean it's a buy. Maybe the story got infinitely worse. You should sell the hell out of it, right? So you got to do the work. Got to know what you own. So in the case of gold, it's many things. In a world where we have crazy economic policies, monetary and fiscal, in a world of increasing geopolitical problems, in a world where the dollar's gone down 99% in the last 50 years and continues to fall, what's the store of value? Gold. Gold's been around 5,000 years, thousands of years. There's the old saw, you probably know better than I, but there's always a saying, come hell or high water, no matter what happens, you can always buy good men's soup with an ounce of gold. All right. Well, I got news for you. It's done so well, you probably can buy 3 good men's soups now. All right. But, gold is an asset which is not somebody else's liability. Gold is an asset which, Jerome Powell just can't print more of it. All right. So if you want to check out of this madness, and actually, gold's done this well despite the bull market and financial assets.
Yeah.
If we get a bear market, I think gold and gold stocks are going to go up even more. How much are going to go up? I don't know. Nobody knows. Give people direction, that's enough. But when you go through exercises like go back to 1980 and look at how much the money supply has gone up, or how much inflation has gone up, and how much gold's gone up, a lot higher. All right. So let's just say gold. I think I was quoted the other day in a post. If we're in Vegas, the over-under, like gold's 5,000, wherever it is today, 6,000 by year end, take the over. 6,500, take the over. 7,000 is probably about right. It doesn't mean anything. What I'm trying to do is contextualize my degree of bullish or bearishness. Because Dave, you know this. You can have ideas and price targets, but what's even more important sometimes is the perceived Sharpe ratio in the idea, i.e., how much conviction do you have, okay? And I've been seeing the ball incredibly well. It's been going up for the right reasons. I haven't seen anything yet which is saying to me, hey, George, maybe you got this wrong. And, as our favorite technician, Stan Weinstein, would always say, it's not the news, it's reaction to the news. So conversely, if I'm a Bitcoin guy, I'd be worried. I'd be very worried. The drivers, was supposed to be digital gold. Well, hold on. Sometimes it's digital gold, sometimes it's a risk asset. You can do these correlation studies. If someone had told you with perfect foresight a year ago that gold was going to double, silver was going to triple, and tech is going to go up, and they say to you, Dave, what do you think Bitcoin is going to do? No one had this on their dance card. So talk about denial. Not that you or I have ever done this before. Oh, no, okay, so I'm not paying.
Never.
It's like okay. So if that doesn't give people at least pause, something might be wrong with their story. then they're not doing this right.
Yeah.
So when you get the driver, like if you had tech down last year, if you had gold and silver down last year, you said, hey, Bitcoin didn't perform. Okay, makes sense. But here these supposed fundamental things happen the way you wanted them to, and it didn't. So, Michael Howe brilliantly pointed out, gold is really driven by global liquidity. It's the foreign central banks keep buying it. There's a persistent bid under the gold price because everyone wants out of dollars, and not just dollars. They want out of fiat currency. The paper money is going to zero, right? It's not the gold price is going up. It's the value of the green thing in your pocket's going down. So I want to check out that system. Gold's one of the few places you can do that. Bitcoin is what the acolytes wanted it to be as well. They're not working out. And so, whereas, gold's driven by global liquidity, Bitcoin is more of a U.S. domestic phenomenon. And the liquidity picture there is not nearly as supportive. Not only that, you don't have the PBOC or the ECB buying Bitcoin. So that's a big difference. The other thing, too, is, people say, well, it's a store of value. Says who? Says who? It's been around, 16 years? Gold's been around 5,000 years. Saying something is a store of value is not a moniker that is granted to someone. It's something that's earned. And it's shown itself to be a very good risk asset. Look, it's killed everything else. I'm on a rant. Let me go here. So you look at Bitcoin, people say, oh, you're a boomer. You know how I really piss them off now? You're going to love this one. Bitcoin has become the Facebook of speculative assets.
Oof.
You get that one, right? Facebook is for old people, right? Okay. It's like, dude, why would you buy Bitcoin when you can do zero DT options? You can do online sports betting. You can do prediction markets. By the way, I should get FanDuel as a sponsor. I discovered this. I just opened a sports betting account 3 months ago. I love it. Okay. Because you can blow yourself up like in 2 seconds. But I recommend FanDuel because they have the best depth in their sporting bets. Okay. But anyway, it's funny. I had a guy in his space a few weeks ago. So I want to come on to yet another reason. I'm all over the place, but you got me excited. You triggered me. The institutionalization of Bitcoin is a huge negative. Huge negative. What? Why? It's dampened the volatility of the item. Okay. Now the degen crowd, they want the juice.
Yeah.
One of the reasons Bitcoin, one of the many reasons it did well was it was in its own little orbit. It was untethered, no pun intended, to mainstream financial institutions. So the crazies could do whatever they want now, right? Now, success has been institutionalized. Oh, gee, it's up a lot. We'll sell some. Let's buy a lot there. So the vol's coming out of it. So I had this one young kid come into my room a few weeks ago, and he says, I really agree with gold and silver. I don't gold, I don't silver. But you're wrong on Bitcoin, about the volatility thing. I said, really? I said, explain to me. They told me, so why do you sell your Bitcoin to buy gold and silver? He goes, well, because the Bitcoin wasn't doing anything. The gold and silver were. I go, you just proved my point, right? You just proved my point, right? So, you have an asset that's highly correlated to liquidity, where the vol's been coming down. You also have stable coins. Okay, I'm all for digital money, but explain to me this way. No one can ever explain what a Bitcoin is worth. Just like you can't really explain what an ounce of gold is worth, but I digress. It's just a convention. After thousands of years of existence, people have said, okay, this thing holds a store of value. You can see over time it works. Bitcoin, not so much. And then they say, well, George, you're a boomer. And over the last 15 years, Bitcoin's killed everything. Okay. David, you know this. Past results are no guarantee of future returns. What they forget to tell you is, what they don't tell you is, trend changed much? Bitcoin is the same price it was 4 years ago. Yeah. 4 years ago. Yeah. So don't give me this nonsense, from 11 to 21, it went up by a zillion percent. Good. I'm happy for you. But how does that inform what's going to happen? You want to take trend, get your ruler out and your crayons, and you say we got tops here. And as Roke would say, Dikembe Mutombo, you're out of business. Now, maybe this will change. But again, if I just show, like I said before, if all you knew was a chart of gold, I showed you that, I didn't tell you what it was, you say, oh, this looks pretty good. I want to buy this. Let me ask you, David, you just look at a chart of Bitcoin. Forget about the story. What's the chart look like to you?
Not great. Not good.
And then the last point, and people are caught the wrong way. Look, we all make mistakes. It's not the point. We're in a business where you make a mistake only 40% of the time. You're great. You can make a lot of money. Just like in baseball, if you make it out 70% of the time, you can still make $50 million a year. But people are incapable, especially the maxis, of having a civil exchange of ideas, puts and takes. They get so amped up. There's so much emotion involved in what they're saying. They can't see straight. They cannot allow any other story other than one that they got. So I have no position. I mean, it's short a little bit, whatever. I just think they're in a world where they're trying to put liquidity in. Like, why would I short Bitcoin when I can buy gold or silver, right? But you put a gun in my head. You said, George, you got to be long or short. I'd be short. And so I think this is one where, again, it's the Mark Twain line. It's not what you don't know that's going to get you in trouble. It's what you think you know that ain't true. Like, you think it's digital gold. You think at a certain point, you got to be honest with you. So you got to mark to market has screwed up your projections a bit and be honest. But these guys, and last thing I'll say, I personally experienced this in 23. I had a horrible experience with an ETF. I'm very public about it. I own it. So I love when the haters come on and say, oh, but how's nope? Yeah, you know what? I screwed up. Isn't that something? I bet you've never made a mistake. Ooh, you probably spent all day trying to come up with that insult. But when you get to a point where, I was short, I was right, and I had all the spaces behind me, and people thought I was genius and this, that, and everything else. And I was dunking on Cathie Wood. And then the market turned. And when you get to a point where the position owns you emotionally, I know you know this, David, as opposed to you owning the position, you got a problem. You got a big problem. All right. And look, I have no idea what Bitcoin is going to do, but I'll just tell you, the parishioners, the acolytes in the Church of Bitcoin, they're so deep down the rabbit hole. They're incapable of having an objective discussion about this. And one of the definitions of a cult is alternative points of view are not allowed. So I actually think, let's put it this way. I wouldn't own Bitcoin at all. Because like the circumstances in which Bitcoin is going to work, I got 10 million other investments I'd rather have.
Yeah.
And if we come back a year from now and Bitcoin's 20,000, it's not going to surprise me. I think you catch my drift.
That discussion on gold versus Bitcoin was awesome, George. And I hope people take time to really think about what you said, because I think, and also you hit on a number of great behavioral things that I hope our next conversation we can dig into further, because I think you're spot on. But anyone that's nervous about gold here in terms of the run it's already have, or silver as well, go back to when you did your interview back in March of 2025.
Well,
look at the chart then.
You're too kind, but you get them right, you get them wrong. I got it very right that time.
Yeah.
And so the Schwab host, I really like her. She was trying to like needle me. It's like, what's a trade? What's a trade, right? Yeah. And it was declaring, oh, it's over. The dollar's going to rally, blah, 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 blah. Even the bulls were saying, oh, well, the RSI is so high and the MACD is so high. We need to consolidate. So, maybe I'm forward bullish on gold, but not here, right? So no one was saying anything, right? So what happens? I come on. She's like, what do you think? And she wants me to like fall in line with the crowd. Yeah. I said, Diane, the biggest bull market I see right now is not in the price of gold, but it's the number of people calling the top on gold. Right? We're all saying the same thing. Okay. All right. And I think that's where we are right now. Now, look, gold's, again, wise ass comment. It's crashed to levels not seen since February 20th. Could it go down 10%? Sure, it can. But that's not the question. I mean, David, you're a pro. You think Peter Lynch is buying stocks? If you get a 10% welcome down, it's welcome. Yeah. As long as you got the fundamentals right.
Yeah.
So I don't know. And silver, it's so manipulated, and that's like the redheaded stepchild of precious metals. But the thing is, you look at the price of physical silver in China, still bid. So what you're seeing on the screen right here is financial silver. Yeah. So I just think, look, the next week or two, who knows when this thing gets produced, because Noble was wrong. We're talking different time frames. Yeah. I'm trying to help you with investing, not speculating. All right. I think this stuff, in my considered opinion, I could be wrong. This stuff's all going to be measurably higher, as well energy. End of the year, do your own research.
Yep.
So
Yep. George, to wrap up here, you and I first met at a chart dinner a number of years ago in Boston. You've got a virtual chart dinner coming up for investors, coming up on March 11th. Tell us about it. What's the event? What's it look like to you?
So yeah, I think it was Eric Wellman,
Yeah, that's right.
and it was the Boston Harbor Hotel or one of the steakhouses there, the
Yeah, one
Palms.
of those. Yeah.
Yeah, it was great. And Guy Strongillo was there. Frank Capilleri. That's when you and I first met.
Mm-hmm.
Dibble's always there. So anyway, you and I have had the benefit over the years of going to a lot of these idea dinners. It was great. You show up, the price of admission is an idea, and you shoot the breeze, have some good food to eat, drink some wine, and you go home with a distended belly, but you got some ideas. And so this concept, what I'm doing on March 11th, is inspired by that. I'm taking 15 of the best guys I know, either top-rated money managers or independent research guys, some of whom you know. And again, they're bringing their best merchandise because this is what they're selling to their institutional clients who are typically paying $20,000, $30,000, $40,000 to get. So this is the best of the best. This is like an all-star team. Imagine you have a concert, you and I, the concert promoters, that we can go all over the world to pick the best musicians to appear at this concert. I know you like music, David. Just so happens I'm going to Carnegie Hall on Thursday night.
Oh, nice.
Joshua Bell's going to be playing, right? Okay, St. Martin in the field, right? Okay, I heard Maxim Vengerov last year. Okay, so imagine you can get the best guys out there. It's like an all-star team. So I was on another podcast recently, Julia LaRoche, who's lovely, this great interviews, and she's a UNC basketball Tar Heel fan. I said, Julia, imagine we're going to play and you got your Tar Heels, and I come in and I say, you know what, we're going to beat you. And you're like, what type of smack is that? Well, real simple. You got the Tar Heel lineup. You're stuck with those guys. Me, I can get anybody from any team I want. It's college all-stars. That's what this conference is. So it's people like, so you want gold? I give you Tabby Costa and Don Dorette at goldstock.com. You want energy? Robert Mullen, Renaud Soler, formerly Fidelity. You want emerging markets? The keynote speaker is Jay Pulaski, former global head of global emerging markets from Morgan Stanley. Adam Parker, former domestic equity strategist for Morgan Stanley. He came to the conference last year. The thing he picked was up like 40% or whatever. So in any event, there's an alignment of interest here. I'm bringing you the best of the best. Some of these guys, the public's never had access to. Tom Chanos charges like $30,000 for his research. He picked Freshpet last year as a short, right? So you're going to get access to guys you otherwise wouldn't get access to. And I feel like a used car salesman. It's only $99. You can't buy anything for $99 anymore, right? And it's online, 10 to 5 on the 11th. Replay is available in 24 hours. Like, to me, like, I wish I had access to something like this when I was at Fidelity. So I think it's a powerful event. We've had a huge, overwhelming response to signups on this. And I think we can say this is now going to be a regular quarterly thing. We've achieved escape velocity. We did a couple of these last summer. The content was phenomenal, but the event wasn't big enough. And so I decided, you know what, let's cut the price big time. So cut to $99. I mean, think about it, David. You get one idea, like, what's that worth? You're going to get 15 of them. So I don't know. I think it's a good idea. That's why I'm doing it.
Listen, great to chat with you today. Good luck with the event. Congrats on the Substack. We'll look forward to catching up with you later this year. But in the meantime, be well, George.
Take care. Thanks, David.
Hope you enjoyed that great conversation with George Noble. George is one of those hilarious guests. You get him talking, and he can share just so many great stories. So my goal as an interviewer is just to kind of get him start to pontificate about different markets. And I knew I could light him up if I started asking about gold and Bitcoin. And George did not disappoint. Just a couple thoughts on what we learned there today. I mean, that relationship, right? That sort of general take between gold and Bitcoin in terms of thinking of them as stores of value. The difference between Bitcoin being around for around 16 years, as he put, versus gold that's been around for 5,000 odd years, right? Gold sort of deserved its label as a store of value. I'm not sure if Bitcoin has definitely has certainly done that yet, and I think we know where George stands on the relationship between physical assets like gold and digital assets like Bitcoin. But there are a number of just really fascinating bits of investment wisdom that were peppered through his comments, and I hope you're able to catch some of those. A couple I wanted to highlight. And number one, thinking about the way Bitcoin and other digital currencies really accelerated to the upside. And what's so interesting about that is people are buying the narrative, as George put it, right? They're not buying an asset, they're buying the narrative, right? They're not thinking about valuation, they're thinking about the narrative, they're thinking about the story. And the problem, the way that bubbles occur in any asset, is those people that sort of have an idea of the narrative, as the price goes up, those early investors feel that their narrative is now justified. They feel like they're now being proven right by price going higher. So, obviously, and again, my opinions on Bitcoin aside, I think what George was describing was, obviously as Bitcoin is accelerating higher, going above 50, 60, 70,000, and then much, much further, is that obviously this is the new store of value. Obviously, this is the new currency. The dollar is dead. Obviously, this is better than gold or physical assets because look how high it's going. And so the way that bubbles sort of really grow and accelerate as the market goes exponential, those investors start to really believe the narrative that they've been following. And again, the price going up is the way that they feel validated. And that works until it doesn't. And we've seen Bitcoin lose 50% of its value in a relatively short period of time. How many times have we seen that with other bubbles and other assets, for sure? George, I kind of knew where he stood on artificial intelligence, the AI trade, and that rotation from kind of growthy growth, the Magnificent Seven, to other areas of the market, which have been certainly quite strong here in the last quarter or two. His point was very appropriate, I think, around that trade, talking about people are confusing price with valuation, right? When I started asking about, can we justify those AI stocks at these levels, it wasn't about the price. It wasn't about the prices come down. It's like, all right, how much are we still paying for expected revenues? How much are we paying now for future earnings expectations? So, George, speaking like an expert investor, which he is an experienced investor, which is you think about what your dollar is actually buying, right? I think too many times, and certainly in the technical community, we're guilty of this, thinking of the price as the thing, right? It's just it's a price. It's a data series, and you're betting on it. You're speculating on it going higher or lower. George is talking from the background of a fundamentally oriented investor, thinking about what am I spending my money on? That is very much the Peter Lynch sort of mentality, right? I mean, what is the opportunity set going forward? Is it worth it buying a company at this certain price, given what that means for expectations for future earnings growth? And price follows earnings. I definitely would agree with George's comments along those lines, and the long-term history of the market sort of backs that up. But there are periods where there's a disconnection between price action and fundamental valuations. Arguably, we're going through one of those right about now. We talked about it a little bit, but I think we talked about it probably more before I hit record for the interview. But George did mention he's looking at the market less, and I think that's really interesting. He talked about changing from managing money, which he did for decades, to now, running a Substack, and basically sharing, insights with the broader investing public here in 2026, and wish him great success with that venture for sure. But he had shared with me how when he was managing money, he realized he was looking at the market too often, and now that he's creating content, now that he's writing and doing interviews and such, he's looking at the market a couple times a day as opposed to all day. And he said, I feel like I have a much better sense of the market environment because I'm looking at it less. And I think that is one of those counterintuitive but absolutely true parts of being a mindful investor, right? We have this sense that if we look at the market more, if we look at more charts, if we look at more news, if we read more stuff, watch more stuff, we're going to somehow be better equipped to analyze the markets and perform well. And to be honest with you, to a certain point, that probably is true. But all of a sudden it becomes diminishing returns. And the more you look at markets, probably the less effective you are, because you're just all of a sudden confusing the issue. You're bringing in too much. And what that tends to do is fuel the emotional side of investing as opposed to the evidence-based part of investing. And we want to rotate, as mindful investors, we want to rotate from an emotion-based investment process to an evidence-based investment process. So I love the fact that George made that comment about looking at the markets less and actually feeling like he had a better sense of things because he was less focusing on the moment-to-moment movements, or what we like to call the flickering ticks. At the end there, we talked about his latest event coming up on March 11th. We'll include a link so you can sign up for that. And it's a true story. I met George years ago in Boston at a chart dinner, and enjoyed talking markets with him anytime I could. I'm so thankful that we had an opportunity to sort of revisit those discussions here today. So I'd encourage you to check that out using the link in the notes for today's episode. Also, we'll have a link to his new Substack, which he just released in February of this year. And again, we wish him much success with the event and with the Substack. George is a legendary investor with just a great perspective, a great healthy dose of skepticism for everything, which I found is the mark of a great investor. By the way, if you want to learn more about some of the ways we can analyze price action, the ways we can make better assessments, not get drawn into the short-term flickering ticks, but understand context, focus on relative strength and longer-term thematic shifts in market trends, our Market Misbehavior Premium memberships may be a great opportunity for you to rotate from more emotion-based investing to more evidence-based investing. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses where we'll teach you about behavioral finance, technical analysis, and all the tools and techniques that I've learned to use to better improve my market awareness and make better, more informed investment decisions. Second, you will have access to our member-only reports like our weekly flight plan, where we look back at the week that just occurred. What did we learn? What was new? What was different? We look forward at the week to come. What levels, signals, patterns are we watching for? We also do a monthly chart review. We do daily market assessments and updates as needed in our member community. And that's the third benefit, access to our members-only community. It is a virtual community of like-minded investors where you can ask questions, you can learn from other investors trying to navigate these markets during challenging times. All of those features and benefits can be yours if you go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today's episode. Thanks again to George Noble for joining us on the show today. As always, we're welcoming of your suggestions for other future guests. Who else would you like us to sit down with and ask great questions? Drop a comment wherever you're listening to this and let us know. We're all ears. We'd love to hear from you. That'll do it for today for Market Misbehavior. I'm Dave Keller, reminding you it's always a good time to own good charts. Have a great day.